We are talking central bank gold buying or lack of gold buying with my next guest today. Jeff Christian is the managing partner over at New York-based CPM Group. Jeff, welcome to the show. Thanks for joining me. We're in the same city, but remote.
Okay, yeah, these things happen.
So I want to get your take, first and foremost, on news that came out last week that Russia would no longer be buying gold, putting gold buying on hold for now. I've heard all kinds of theories as to why. Some saying, well, you just can't get gold because you can't, they're not buying gold because you can't get gold right now. What's your take on it?
I wonder where these theories come from. I mean, there's so many just totally baseless comments like that. What's happening is very simple. The Russian economy is in bad shape. It has been in bad shape. It's been suffering from sanctions. But now the Saudis have started an oil price war with the Russians. Now, Russian average oil price production costs are about $42 a barrel. The price of oil has been below $30 since the price war started. So Russia is losing money on every barrel it produces on average and sells. So it's been shutting in a lot of its production. 70% of foreign exchange earnings in Russia come from oil and gas. Something in excess of half of the government's tax revenues come from oil and gas. Something, I think it's close to 65% of the federal tax revenues come from oil and gas. If you're not turning a profit in your oil and gas business, you're not paying taxes on your profits. So the Russian government is strapped for cash. It's facing the pandemic that everybody else is facing, but it was slow to move on it, so it's got serious problems there. It still has sanctions. It doesn't have a lot of foreign exchange coming in. It's losing money on every barrel of oil that is sold in Russia. It doesn't have the money to buy gold. And it's nothing less than that. It's nothing more than that. You know, there's plenty of gold to be purchased. Gold production and refined production is continuing. There's gold out there. It's just that they don't have the money. And this, you know, there's a historical precedent that goes back from 1996, 1997 until about 2005 within Russia too. And it was the same thing.
Jeff, what about, do you think we will see countries like Italy, that's obviously in an incredible economic crisis right now, and one of the largest gold holders in the world, do you think we could see a movement of countries selling their gold to get out of turmoil?
Highly unlikely in the case of Italy. I mean, Italy has had they haven't had problems as severe as this one, but they've had severe problems over the last 50, 60 years, and they have not sold gold to get out of that. So I doubt that they'll do it this time. I think the Italian government would be much more likely to sell bonds and to borrow through the ECB than it would be to sell gold.
And what are you seeing, Jeff, in terms of investment demand for gold?
Well, we've seen a big pickup. I mean, you know, one of the important things to remember is that investment demand for gold and silver in 2018 and 2019 was extremely low. We had not seen, we saw about a 90% decline in investor demand for physical gold and silver from 2013, 2014 to 2018, 2019. And that's another important factor in terms of the supply chain disruptions. The wholesalers and retailers of investment products for gold and silver, coins and small bars and such, have been financially constrained for a couple years now. Some of them have actually gone out of business or they've merged with each other. They've had a lot of problems in terms of their own financial stability, given the lack of demand over the last couple of years. Now, then the price rose, and the price rose initially because of futures and options and ETF trades, and all of a sudden, the financial constraints on the wholesalers and retailers of physical metal were constrained by the fact that the inventories that they had were of much higher value. And then you started seeing, really just in March, if you look at it, investment demand remained low in January and February in most parts of the world. And then it surged in March. And all of a sudden you had all these people saying, okay, I need inventory, but I don't have the credit worthiness to borrow additional money to buy more gold and silver coins. And then it was like, oh, the good news is I couldn't get them even if I did have the money to do it. So, a big part of the supply disruptions and the supply chain disruptions isn't the refineries, it isn't the airlines, it's the fact that the wholesalers and retailers of investment coins and products have been financially constrained and are pushed, in many cases, up against their credit limits.
Valid point, Jeff. I also wanted you to shed some light on probably my, the second most asked question I get is why we're seeing such a difference in price quotation between gold futures versus spot price.
Well, if you're talking about spot price, I assume you're talking about the London spot price, and
yes.
that goes back to something I said earlier. For 2 years, investors have been buying on a net basis 90% less gold and silver than they had been buying just a few years earlier. Now, what you've seen is a tremendous amount of selling of gold and silver, spot physical metal, back to market makers. The selling tends to take place in London. That's why you have record volumes of gold and silver stacked up in London. And the market makers, they have their own financial constraints. They have to hedge those positions in order to satisfy their financing sources. And in order to hedge that position, you have to have a contango wide enough. Now, the credit market is constrained. You can't, so you're buying a lot of gold and silver. You've been buying a lot of gold and silver for 2 years. Now, all of a sudden, there's a big flood of it because other people are selling their gold and silver to raise cash or because they just can't afford to hold those large positions at the higher prices with higher margins and higher collateral requirements. So all of a sudden, the market makers have a lot more metal. They can't really find buyers in the physical market, so they turn to the COMEX and they sell into the futures market. That's why you saw when you looked at March or the April COMEX gold contract, at the beginning of March, there were 51 million ounces of open interest in the April contract. And over the course of March, those contracts were bought back as the people, those were hedged positions primarily of metal that was either held in London or held at fabricators or held at refineries. And so you have the surfeit of physical metal, which is pushing the spot price down, and you have a surfeit of metal in the physical market in London, which is pushing the London spot price down. Meanwhile, you have a large open interest on the COMEX that needs to be rolled forward by the shorts because those shorts are hedges of the physical longs. Now, I have to buy back my April's and sell June contracts. And that puts upward pressure on the April contract. And that's why you had a $70 split between London and April COMEX. It's really just a function of the difference between the futures market needing, having this upward pressure on the April contract and so much metal backed up in London and Zurich.
No, and I appreciate that explanation because, I'm sure you could understand a lot of people who might be new to the market here are scratching their heads thinking, how can there be such a difference?
The problem's not the people who are new to the market. The problem is the people who have been in the market for 10 years or 20 years, and they're still saying this stuff. And they, oh my God, and I listen to it on Kitco all the time. There's a conspiracy theory that Kitco puts these people on the air so that people hire CPM Group to explain what's really going on in the market to them.
The real story is we are a neutral news source that invites all voices.
And you
opinions.
Don't have a peer review. You don't have anybody who says, that guy just doesn't know what he's talking about in gold and silver. We should have put him on.
Well, now I brought you on to have the counter argument.
Yeah. It's just it's surprising the cockamamie stories and explanations that come up. And no one has ever heard of Occam's razor in the precious metals market.
Jeff, just looking at a more of a global economic picture here, when do you think life could resume and go back to some sense of normalcy here?
Well, it's really anybody's guess. There's so many uncertainties. We're leaning toward the idea that it could be a V-shaped recovery. You're talking about another month, maybe 2 months of global shutdown. But when it comes back, it could be a relatively rapid initial recovery and then a slower growth. So you're looking more, not necessarily at a U-shape or an L-shaped recovery. You're looking at an initial V spike as you start to recover, and then it grows more slowly as it did from 2010 to 2017, 2018. So, it could come back fast. And, one of the industries that probably pops up the first is the airline industry, because once you're free to travel, everybody's going to start traveling to rebuild their industries and their businesses. So, but I think it's a couple months away before we get to that point.
Jeff Christian, Managing Director of CPM Group. Thank you so much for joining us today, Jeff. Thanks for taking time to speak with me.
Hey, it's good to be with you.
And thanks for watching. We will have much more for you, so be sure to stay tuned to Kitco.com.